We are live now. Good morning, everyone. Thank you very much for joining us again today for Tax Tuesdays. These are deep dive sessions into corporation tax. So they're not like, we just touched the surface and we're just trying to go through some of the basics. We spend a lot of time and effort looking at the deep issues that that companies and entrepreneurs do need to focus and think about. I do recommend, if you're an entrepreneur and this is a bit too much for you, send your accountant to come to these sessions as well, so they can understand some of the things that they need to take into consideration. Because tax is corporation tax law is quite meaty now, and there's so many different branches that you have to kind of take into consideration. So that we recommend that. Sessions recorded, so will be shared on YouTube, we shared on LinkedIn, and we will have Q&A at the end. Just a disclaimer, as we do every session, we're not providing you with advice. We're providing information on the law and guidance. So anything that you hear from here, you need to get professional advice, or you need someone to you need to have an engagement letter with a tax professional before you start using that advice or not using it. So just want to put that out there just to make sure that everyone's aware of that. I'm joined by Rashmi. Every week or every session, I tell you that Rashmi is the most knowledgeable person in corporation tax that I know in the UAE. So she's not going to let us down, no pressure. She's my go-to person whenever I have any technical questions myself, and she's able to answer pretty much all of them. So thank you, Rashmi, for putting up with my stupid questions. In my company, I do say that no stupid question is a bad question. So thank you very much. Rashmi, do you want to just give us a quick introduction about yourself?
Sure. Thank you, Rehan, and always appreciate the kind words. And as you say, no questions are stupid questions, but they can be very costly questions as far as tax is concerned. So we might as well ask them rather than not ask them. So yes, myself, Rashmi, I'm a CEO partner at JRB, work closely with Rehan on whenever we can collaborate on tax or accounts or whichever way we work together. Thank you, Rehan, for doing this. You are putting in a lot of effort, and it means when professionals like us would take this time to give the deep dives where industry needs it. And that's it. I like the idea of deep dive which came from you, because there's enough surface level discussion, but then you need to know, and it's very important. And I think I was suggesting after this we'll do a series. After we have covered 2-3 points, we will do a session on how it integrates all together. It's very important. We are looking at things in bits and pieces right now, but then when we put it all together, it starts making a lot more sense, and the applicability becomes more clearer for the businesses. So yeah, inshallah we get there soon.
Inshallah. No, thank you. Yeah, 100%. Like you said, a silly question could actually be an expensive question. So 100% right on that. Today's session is going to be about the transitional rules. Now, I know that on the ad we put ministerial decision number 120, and we did that for a reason, because some people understand what that is and some people don't. But this is very, very important actually, because you have to remember that you're doing your corporation tax for the first time. So as accountants, yes, your tax calculation is based on your profit and loss, right? So your P&L, what's your net profit is your starting point in terms of your corporation tax. However, for those who are savvy or non-savvy accountants, you also have your balance sheet as well that you have to take into consideration. Now, your balance sheet will have certain items that you release, or you accrue, or you may have property. There are a number of factors on your balance sheet that does, in the end, affect your corporation tax liability. So we'll go through some of these as per the ministerial decision number 120. And so it's very important that you do take this into consideration when you're thinking about your corporation tax return. Now, obviously, right now, everyone's probably still closing the books. If you've closed it, well done. Good gold star for you guys. But if you haven't closed your books yet, then this is something you need to think about. Also, some of you guys may not have finished your audited accounts as well, right? So I know this is mandatory if you're more than 50 million dirhams of revenue, or if you're a free zone. But for some companies, they may want to do an audit before they start the tax calculation, just for best practices, for example. And so if you haven't closed your audit yet, you may want to come back and revisit some of the rules here. So I'm not going to blab on anymore. Rashmi, the floor is yours.
Thank you, Rehan, and thank you for starting and setting at the baseline. So good. I'll carry on with one topic of yours, and I'll dive into 120 soonest. Audit for corporation tax purposes, 50 million, yes. Qualifying free zone entities, yes. However, I always need to re-emphasize everything that you will report for your corporate tax, the starting point, the adjustments, the terms and conditions, everything derives from your numbers being right according to IFRS. And it is only prudent that the management tries that it takes a second opinion. If you have a smaller accounting department, and if you have a limited accounting department, whether you do your IFRS compliance review or you get an audit done, whichever way, but then you have a layer of responsibility between yourself and the compliance. You as an owner might not know IFRS as such, but the numbers you declare is your responsibility. So to see that your numbers, all adjustments, okay, but then the start point, your numbers were right according to IFRS, especially if you have never done it, at least one time exercise of looking into your books and your recording, being IFRS compliant is super important now that corporate tax, all regulations, all adjustments, everything goes back based on IFRS compliance. So since you mentioned, yes, if you've not closed your accounts, if you've closed your accounts, if you're still studying, you should look into your compliance of IFRS before you even start with your corporate tax compliance. So yeah. Ministerial Decision 120. I really like this concept, and this is because this is very specific to regions like UAE, which is rare that we do a transition. We have seen a VAT transition, and now we are seeing a corporate tax, and it's very interesting when you have a movement from a non-tax regime to a tax regime. And it calls in for special considerations, which is not very prevalent in many regions. Most of the regions have not seen this happen. So this is something that needs a little more of understanding and how it impacts us and what should be the choices made. Okay, so starting with ministerial decision, we have to make this choice. This is an election. These are elections that you will make. And as I always say, that elections are super important, and most of the elections are one time and irrevocable. Other than 3 elections, which are revocable, all other elections remain irrevocable. And that is also true about the transition provision rules and the transition elections. So why is it important to understand? When you will file your first return, you will make election. You will make election that whether you want to apply for the benefit given under different circumstances under the 120 ministerial decision. And when you file your return, if you want to go for this, it's not that you can decide that time. You will have to have a lot of preparation. You will have to have a lot of documentation. You'll have to do a lot of study and calculation to know whether you want to elect for this and whether you have an option to elect for this or not. And that's what we are trying to clarify here, that what you need to prepare to make your decision. You have options, and transition provision should be looked into in collaboration with your unrealized and realized gains and losses. We'll try and cover that in the next sessions. So you will realize that what should be your choices and whether you have those choices options or not. So going on, starting with the election part, we have said that why is it important again in transition provision is it's interesting that you will make elections for 3 different categories separately in your rules apply separately for 3 categories. They have divided into main 3 categories, which is one for your immovable assets, one is for intangible assets, and third is for your financial assets and liabilities. So for each type of asset, you will make a separate election, and provisions apply differently for each of them. And this will be done during your first return. It is irrevocable. And even if, what is important again, as I always say, that even if your business is small today and you do not have certain type, but then if you think that if I will start having more financial assets or liabilities in the previous ones, do you think that they will make a impact on me? Or today the immovable property I hold, will it become a big value tomorrow? Would it impact me tomorrow? Would I want to, today you don't want to sell, you're occupying, but if I sell, what will be a issue? So that's what you need to consider, that what are you going to do in future. So I think we'll start with the immovable properties, and I will not take a lot of time because we have a lot to cover today. Three tests are basic for all the types of assets, whether it's again immovable property, intangible assets, or your financial assets or liabilities. These three tests are mandatory to qualify to be able to take and elect for a transition provision benefit. One is a measurement test. This is super important, that all your assets and liabilities that we are talking about right now have been held in the books at historical cost basis. If you're not holding your assets, say immovable properties, depending on whether it was a property, plant, or equipment, and investment property, whether you did a revaluation or you're holding at a fair value, then you cannot opt for transition provision benefit. This benefit is only available when your immovable property, when your intangible assets or financial assets and liabilities were held at cost in your books of accounts. So first foremost test, you go and see it in your books, that were you holding it at cost or not. Second is that you should be holding the asset clear title according to, again, the IFRS kicks in. Your ownership should be at the start of the first tax period. If you're paid advances on certain assets, if the risk is not transferred, if you cannot book it as your asset as on the start of the first tax period, you cannot utilize transition provision. And you are expecting a gain or a loss during the first or any period beyond the first period. These are the three conditions that you need to meet for all the categories to be able to take the benefit of transition provision. So now, getting into the most interesting part, that is your immovable property. Next slide. So immovable property, intangible assets, and financial assets and liabilities. We'll cover, these are three articles, different articles covering all the three types options available. We'll look into them one by one. We'll start with immovable property, which will be of interest and most significant impact in bigger balance sheets. As we said, we have to have had the asset in our books, immovable property, any land, building, whatever you're holding, you should have carried it in your books at cost method. If you had done that, only in case of immovable property, you have two different methods based on which you can take this transition provision unrealized gains benefit. Why does transition provision give you any benefit? What was the logic behind it? Is that, okay, you bought a property in, say, 2020 or 1982 or whatever, and tax came in today, and you sell the property 2 years later. The actual gain that you had on the property was across the period holding of, say, 22 years or 32 years or 40 years. So you are not liable to pay tax for the benefit you earned when there was no tax in the region. So if my gain of, say, my property went from 1 million to 4 million from 82 to 2024, that part I should not be liable to pay tax on. Only the portion that comes after that, after the tax regime, is where I should be asked to pay tax on. So that's why transition benefit, this is what the whole purpose of giving you a transition benefit, that any gains you earned before the taxation started, you are having an option not to pay tax on it. Of course, you have to fulfill certain conditions. What is
Just,
interesting,
just to
tell
kind
me.
of add some emphasis.
Yeah.
Obviously, in Dubai, property prices have gone super high, right? Years ago, 5 years ago. So you do need to check what's on your balance sheet and see what you have on there to see whether this is relevant for you. Because imagine if you bought a property for, like, I don't know, 100,000, and now it's worth 10 mil, and you didn't go through this process. You know you'll be paying a lot of tax. And I think this is super important. Um, so yeah, no, I think this is very important, especially and to be honest, a lot of people don't even look at the balance sheet, right? So maybe this is
Yes.
something that they should start doing, or if it's not on your balance sheet, make sure that sometimes you might have a title deed, right, but you might not have recognized it, because some companies don't always do their accounting correctly, right? So for whatever reason, I'm not going to judge anyone, but I've seen it many times. Um, this is super important.
Yes, and as you said, so again, going back to the principles, as you said, first IFRS books compliance. So if you have a property, first of all, it has to be in your books. Start booking it right. And I will conclude this. I will connect to your conclusion soon once we have seen the two methods, because this has helped. This is super good for the tax assessees, that the market was at a high when the transition provision or the first tax periods came in. So because if you take those valuations, we were at a high, and you can take a lot of benefit if you take your valuations right, or if your period of holding is not too long. So you need to make this calculation, and you can derive a lot of benefit out of it. And alhamdulillah, because the market was at high. If it was at low on transition provision, your value should have come down. But because it's the cost will go higher, you can actually reduce your tax liability later a lot based on this. And coming to this, what is also interesting in this is we'll go to the two methods, but the election has to be made property by property. And this is also very good because you do not need to club all your properties. One might have a different scenario, another might have a different scenario. One you might have bought in long back, and one you have just bought in. And the tax impacts can be different, right? So property by property election can be made. And therefore, this assessment again gives you a lot of benefit, and you need to take that consideration. For other class of assets, it's a whole class of asset taken together, but only for the immovable properties you make the election property by property, and hence the calculation becomes important. Because we would be dwelling with one concept across all the three, I would like to clarify. In this, when we get the benefit based on either the market value or the holding period, the holding period actually includes the taxable person's holding period, but it also includes, if you are of the same tax group or of a qualifying group, the period of holding of the previous holder as well. Of course, you need to qualify for certain terms and conditions, but then you also need to see when you're planning your tax groups, or when you're planning your qualifying, looking at the assessments, you have to see that the period of holding of those entities will also be included in the holding period calculation. We'll come back to this concept. We'll understand how the holding period comes into play once we go through the calculations. So, what are the two methods of calculation available for immovable property? One, next slide. One will be the direct method. It is, you will take a valuation as on the first tax period starting date, the market valuation. So here's, I purchased a property at 100,000, say in 2021, and the market value as on 31st December 2023, presuming a January to December tax period, is 1 million. Then I will take this 1 million minus 100,000, that is the 900,000 as the excluded gain. Now, this excluded gain sits in my calculation. When I actually sell the property, say at 1.5 million the next year, 900,000 worth of profit, I don't pay tax. I only pay tax on the balance period. So, what you are doing here is basically calculating the excluded gain. Out of your total gain, if I sell it at 1.5 million and my cost was 100,000, my total gain is 1.4 million. Out of that, what is the gain that is excluded to calculate what is your taxable profit? So, what is excluded is the gain that you already earned on the first tax period date. What is important here is the valuation has to be by a relevant competent authority in the state. Now, this is super important. It cannot be that you just presume or you calculate it internally or you have any valuer which is not an approved valuer in the state. So you have to have this valuation. The valuation should be taken as on the last date of the non-tax period or the first date of your tax period. This is super important. So today I can go to somebody and tell me to give me the valuation as on 31st December 2023. And that's what you need to get. You don't need the current valuation, you need the valuation as on that date. And this report will be required to get this benefit. So this is a cost you will pay. You will incur a cost to get this benefit. So you should know approximately what benefit are you seeing by 9% saving on the gain to know whether you need to or you want to go for the valuation versus the other method. So you need to see this cost. This cost will only be incurred if you go by valuation method. So this is the valuation method. The other method available is the indirect method, that is the excluded period of holding. So this one is based on the valuation. This other one is based on the gain based on the holding period. So out of my total holding period, what was my holding prior to tax? Only technical, which I'm not very convinced is a very logical way of calculation. However, the law defines it very clearly that you need to see what was your gain till the first tax period. And that gain has to be proportionated between your holding till the first tax period and your total ownership. And this calculation has to be done in number of days. For ease of discussion, right now I'll use years as the terms, but then actually this calculation has to be done down to the number of days and not to the years. So basically, what's the idea again? If I held a property in 2021 or bought a property in 21, I sell it in 25. Then I say that from 21 till 31st December 24, the number of days, whatever it was, that will become my numerator. And the whole total holding period, that is from 21 till 25 sale date, will become my denominator. This is a proportion that I'll apply to the gains that I have overall earned at the first tax period. That value is again my excluded gain. So now here, without getting into a lot of technicality of calculation, when we sit with the formula, we understand the calculation. What do we need to consider? In proportionate period basis, you don't need to get a valuation done. Second, you need to see how lengthy was your ownership period versus how presumably is your market rate sitting at the end of 31st December. In most cases, it's not a general rule. In most cases, if your holding period is really low and you have a lot of gain due to the market price, then it will make sense to go to the market price. But if you think that the property value went up before and your holding period is quite long, we have companies here holding properties for 30 years, 20 years, and you think you're going to sell it immediately or very soon after the tax period starts, then your taxable period will become very small and your length of holding of the previous prior to tax period becomes lengthier. There it makes sense that you choose for this. However, I strongly recommend an actual calculation is done and then you take the benefit and then you make the choice. And if you make the choice of going from market value, you apply and you get a valuation done. uh, how this will actually pan out. It is very interesting to see practically when I file my first return under my immovable property. Under each property, I'll have to make a choice that whether I go for transition provision. However, the election method is not to be selected yet. You can keep it open, but the valuation has to be declared as in first period. So I don't need to say that I want to go for A or B because I don't know, maybe actual sale is later. But then if you want to take the benefit of election A at any time later, you need to keep the valuation and upload the valuation there. So, or you will have to tick that there. So you will have to see how you go property by, and this election has to be done property by property. This is your properties. Moving on to intangible. We'll summarize it later, how the differences come out at the end quickly. Intangible assets will only give you the benefit, that is the second benefit, that is the proportionate holding period method. So in intangible assets, market value method is not available. Intangible assets only give you an option of taking the benefit of holding period. Interestingly, for intangible assets, the maximum period of taking a look back limitation is 10 years. So if your intangible was held for 22 years or 15 years, maximum that you can look back limitation is 10 years, and then your actual holding period, and then you will do the proportionate method. In intangible assets, all qualifying assets, like all your intangible assets, will be covered by one election. So, unlike property, you cannot make intangible asset wise election. So, the whole group put together, you should consider it put together and then see what will make sense for you in making this election. Moving on, again, the basic always remains applicable. The intangible assets should have been carried on in your books at cost, and you should have had it at the first date. The rights should have transferred. All those conditions still remain applicable.
Just a few questions. So,
Please.
intangible assets, we're talking about patents. We're talking about, um, you know,
Copyrights, softwares.
copyright softwares. Obviously, they have to be registered. Um, what about, when you consolidate goodwill on consolidation, when you buy a company? So, for example, you might buy a company for 100, but it's worth 50. So that 50 is then recognized as goodwill in your consolidated accounts. You don't impair it. Is that also part of intangible assets as well?
Yes, this was a discussion we had at a lot of length. Now, this will come into play only when you're registered as a group and you're reporting on consolidation basis, right?
Ah,
As soon
okay.
as and and yes, as far as it's not just about, so intangible, they have not limited it to any asset as acquired or anything. As far as you can recognize an intangible asset, as far as IFRS is concerned, if your books
Yeah.
has intangible assets, then this rule will apply. Now, it would be interesting, and therefore what has helped here is that you do not actually do a uh, market value assessment, and it is only proportionate based. So it's easier for any class of intangible assets, because it's sometimes challenging to have the valuations done correctly as on a period date. So it is only on the basis of period of holding that you will get this benefit. It is also interesting, this one, goodwill actually is a little more technical than other intangible assets, because it will also get into play when you will actually realize, right? It is on the realization. So when you're realizing, you're actually selling off a subsidiary, so it's more of a business sell by profit, and whether you actually allocate it to, so goodwill actually needs a lot of analysis and how it sits and what is the transaction type,
Yeah,
and
I guess
when you sell. Yeah.
yeah, that question I guess is mainly for large groups, but for SME, it's going to be patents and intellectual property and
Intellectual properties and
you know
softwares, and yes, and the
exactly, yeah.
10-year period is the cap. So in this one, the only differentiating factor, so immovable property, second option, all other conditions remaining same. Two differentiation: one, you do not make asset wise election, and the period gets restricted to 10 years, and beyond that the period is lapsed. Moving on to our third, and I'm just conscious of time because I think, yeah, financial assets and liabilities. In this, the only method available is the market value method. In this, the period of holding method is not available. So, for all your financial assets and liabilities, you can only take the market value as of the start of the tax period and compare with it. You cannot take the holding period benefit here. Single election for all qualifying fixed assets and liabilities. Differentiation between the others and here, critical one is, other two categories you can take the benefit only if you have gains. In this, because you are having multiple fixed assets, financial assets and liabilities, and each one script line can have a benefit and gain, because we are doing market value, it is line wise calculation. Gains and losses taken together, the calculation has to be done. So you do not ignore the losses, you also take the losses. You take the market value of all, because you do not make election asset wise. You take the market value of all your financial assets and liabilities, then you take their market values, and then you do the adjustment calculation, and that adjusted calculation of losses and gains set off together will reduce. So you cannot keep the losses out and only take the gains benefit. It will reduce if you have losses script wise or asset wise. It will reduce your excluded gain calculation. Now,
So
if you see,
examples of, sorry,
tell
so
me.
for examples of financial assets and liabilities, are we including inventory? Are we including trade debtors? Are we including creditors as well?
Yes, so you're taking all your financial assets and liabilities. So it is including your receivables, if you have made any short term investments, if you have anything that classifies as your financial assets and liabilities, you will include all of them, short term investments, your low, whatever you have under these categories, you will club them all. And therefore, it is important that you know that what are their market values as at the starting period. And here is where the importance of having your IFRS uh, compliant books, that you have done the assessments, that you have. However, it is very important to see that you are carrying the assets and liabilities at cost. Now, this is super important because you know what has happened is that when you start making these assessments, you will find that very rarely in financial assets and liabilities, very rare that you would be carrying it at cost, because we comply with the IFRS. We will be complying with the ECL calculations. We'll be making the provisions. Then whether you have elected realization basis or not, and if it's not carried at cost, then you go to the benefit of realization. So each line item, you would start from, okay, this is my asset type. Do I have I carried it in my books according to fair value, revaluation, ECL, whatever? And then, is transition even available to me? If yes, then this. If not, then you go to the realized basis calculation, and then you see how you take benefit there. So it's a super interesting exercise, and because you have to do it for all financial assets and liabilities together, this exercise needs to be done in detail and now, so you know, again, for your provisioning, to know what documents you require, what details you need to maintain. You need to know that these calculations are available to you. So this is more or less all of Ministerial Decision 120. One or two conditions that we need to see, that what would be the practical or documentation requirements if we are going to go through these transition provisions. One thing which I have asked a few people, and on discussions we are still not clear and needs more clarity, is that in immovable properties, it is a precondition that the market value has to be from relevant competent authority in the state. Now, if a company holds a property outside UAE, can you actually get a valuation from a relevant competent authority in the state? And if the relevant competent authority in the state cannot give you the valuation, do you disqualify from getting the benefit? So nowhere I have seen any other provision which restricts getting this benefit of properties held outside UAE. They do not restrict it, but by one this precondition, maybe we have put all those class of assets not qualifying, or maybe they will give that a similar relevant competent authority should do the job, but we do not know it yet. If you plainly read the text of law and not the intent of law, your properties held outside UAE is something we need to consider, whether they can get the transition benefit or not.
The key word there is competent authority, right?
I won't even start commenting on it. And it is in the state, and that is something that might put the properties held outside up for a discussion, or
Yeah.
it's super relevant that we seek a clarity from the FTA on this. So I have not concluded on it whether it's a trouble or not yet, and nor have I been able to have a discussion with any other person who has concluded it yet. So that's an interesting open thing, according to me. Intangible assets, we need to see that the evaluations align with the standards, because we have to take it in the cost basis. So what you have recognized as costs should be right, and you will get the benefit on the basis of period, but that profit what you're carrying in the books, the value of intangible assets that you're carrying in the book, that cost has to be according to IFRS, according to accounting standards, should be maintained, right? And financial assets, because we will have to do market value assessment and you only get the market value difference. So you need to see that you are able to do. There would be certain challenges where you have companies, we have made investments. If it's not in listed investments and you have made investment in smaller companies and they're small value items, you'll have to see how you determine the market value of them, and you keep this data ready so that you know whether you will be able to make that choice or not. Still, we do not have any clarity how they will ask for these reportings to be done, whether these schedules are to be uploaded yet, because there is no tax audit as such, whether the documentation, but it's, if not today, then tomorrow on assessments, these documentations and the workings and calculations have to be ready with you. I think the next slide is the last one, and then we are done. So historical acquisition documents again become important because we are going to take that date, and therefore whether you recorded in the books on a particular date or not or whatever, but then your historical acquisition documents for your costing and your date of acquisition becomes super important. Your valuation reports where it's applicable, your ownership records and calculation workings, super important, because it's the first year you are making critical decisions. Always have a two review check, one person calculating, one person doing the due diligence, whether it's rightly done. Because these, suppose you go for a valuation method and you take the report, you expend on it, but the calculation was wrong and it was not supposed to be done. So super important that you are relying on the workings correctly. That's all from me.
No, thank you very much for that detailed deep dive discussion on Ministerial Decision 120. We've got one question. Before I go to that one question, I just have one question for you, which might be quite relevant for some of the audience. So let's say we have an immovable property and we want to recognize the gains as of the 31st of December 2023, right? 2024, sorry, 2023, right? And we want to recognize it for tax purposes. Now, we're not going to change do we have to change the books, the valuation on the balance sheet, or is it like a tax adjustment we have to do?
I think I should have clarified this, and this is a super important point you brought in, practical aspect of it. None of this adjustment needs to be or can be made in the books of accounts. Again, because I need to carry my books of accounts at cost, I cannot adjust the market value. This is a declaration out of books, and now this is a concept we need to become. And this is also a thing that is super important, where the technology will kick in, because where you are preparing your tax returns and how you are keeping these assessments, calculations and supporting documents, because now you will have to keep the records of two sets of things. One is your books. My books carried something at cost, okay, but then I selected this, I took a loss or benefit of this particular script in this year. All these tax data, which is your adjustment out of your books, need to be kept for at least 7 years, or we will see if more in case of tax losses calculation or whatever. So how we are doing it is, you have a book profit and then you make all these adjustments while making your computation for taxable income. You started with your net profit, and while calculating your taxable income, these adjustments are being made out of your books. The data and the records will have to be kept, and you might have a very robust accounting system right now, but then you will have to have a very good, not a promotional exercise, but something like Techstar, but then some I did it right? So something like Techstar or something. But jokes apart, there are provisions where you'll take the benefit for unlimited period of time. Your tax losses are indefinite. Your interest is these many years. Your certain, when we go to PI and when we go to others, they have now clarified under the decision 302 that certain benefits will be lapsing after 7 years. Now, when you go to these things, these data are not sitting in your books of accounts, not in your accounting software. They will sit where your computation is made. And it will be important that you have this track record available both for assessment and for correct calculations. So these are all adjustments, Rehan, which are bringing a benefit to your taxable income. No adjustments required in the books. So if you've closed your books, you can still make this adjustments, but you need to see whether these benefits are available or not.
Yeah, no, no, good point. We've got 5 more minutes. We've got one more question. So this is similar to what I've asked, but I guess it's relating to what you've mentioned. So Mustafa is asking, do we need to prepare opening balance sheet and restate the balances of all related party transactions at the ALP? I don't know what ALP stands for, but
Uh, I think this question is more related to where the provisions ask you to be compliant with your transfer pricing and uh, those benefits rather than the transition provision. So if we stay at transition provision, as I said, you do not make any adjustments in your books because it's rather that you carry everything at cost. You cannot make the adjustments. Super important that we do not start if you want to, and this confusion, if you think that I want to make this choice and therefore I want to make the adjustments in the books, you rather lose the benefit than you actually get the benefit. So you cannot, you should not, and you're not allowed for this benefit to adjust your books. Also, because it's your accounting policies, right? You cannot just change. If you have been carrying something at cost, your IFRS will not apply to allow you to shift from one policy to another. If your valuation methodology has been cost for your fixed assets, if you want to move to revaluation, it's a policy change. Uh, it is not just adopting a figure. And then so first of all is that policy selection, and if you have been following the cost method, then follow it, take the benefit out of the books and not in the books of accounts. As far as your transfer pricing adjustment balances is concerned, I think it's a very different and a detailed topic. And the practical side, if it needs to be seen, and therefore we have not taken up the transfer pricing topic as yet, and we would, inshallah, take it in within next 2 to 3 weeks, where we'll be able to say, because this question is pertaining to opening balance adjustments, I guess, because your opening balances have to be transfer pricing compliant as well.
so I think maybe this is something that Mustafa can take offline with Rashmi.
Sure.
I think it's a very important question, and I think there's a lot of
Ifs and buts and terms and
conditions. Yeah,
conditions.
exactly. Yeah, that you need to understand before you can provide an
So
answer.
anybody who wants to get in touch with me, this barcode works, my LinkedIn works. If you have
Yeah,
direct questions, you get my contact details on this barcode or from LinkedIn. I'm available for a chat or discussion if you need any clarity on it or any questions on the topics we discuss. Yep.
yeah, and then just going back to financial assets and liabilities, I'm going to ask you questions because no one else is. So I'll take up this time. One last
Please.
question, right? So we mentioned immovable properties. We don't make adjustments on the balance sheet, right? However, with financial assets and liabilities, let's say, for example, I have my trade debtors at 100,000, right? And for example, I've got 10,000 that is doubtful. Um, Now, for whatever reason, you may decide to keep it on a balance sheet, or you may decide to write it off. Um, I'm just trying to give you a practical example where
So,
SME would kind of
so,
would apply this, right?
yeah, yeah.
Does this apply in that situation, where, for example, the market, the market value is different now because we think that our trade debtors, our receivables has dropped by 10,000, for example. So are
Correct.
we allowed to then, on the opening balance sheet, write it off into the P&L, which then, um, incur an expense as a result? Is this covering that, or is this something different to those rules?
No, so again, we are not making that adjustment also. So very unlikely, that's what I was saying, that we will have to see, very unlikely in case of your financial assets and liabilities, that you would have a lot of financial assets and liabilities which you have not adjusted, because a fair value, the IFRS 9, we are all calculating the ECL, taking it at fair value, and mostly we record our fixed assets and liabilities at fair value. That's a more prudent method, and that's more acceptable method how we are carrying it. The transition provision is not available. However, if you see, okay, let's see the principle and crux behind it. If we are
Yeah.
carrying it at fair value already, what has happened? All your profits and gains and losses as at the starting period of the tax period is already recorded in your books. So when you will go on realization basis, now here is where the election of realization basis will kick in. And when I go and I say, okay, I was not carrying it at cost, I was carrying it at fair value, and my opening fair value is this, and now my tax should apply to this. Logically, your transition provision benefit you've already got. You actually adjusted your market value as at the end of the last year, and now
Yeah.
you are paying the taxation only on the balance of the period. When you were carrying it at cost was the problem, because your earlier adjustments were not being done. So that's the logic behind each asset that is carrying at cost needs the transition provision benefit. If you have applied already the any other method, that is your evaluation fair value methodologies according to any other standards of the taxation, then you've already taken this benefit. And only the then what becomes important is your election when you're selecting the realization basis method or not. People are only thinking that realization basis method, that I do not want to pay for provision or not, will apply on your future going, but then it will hugely impact if you're not taking the transition provision benefit. So this is what I think we should next session or the very next, we should try and cover the realization basis, and then we'll connect the transition and realization basis. And there is where this fixed asset or your receivables ECL calculated yes or no, and what choices can and should be made will be clearer.
Yeah.
I don't know
No.
if I clarified or confused you more, but then
No. I'm just trying to put like stuff out there
yeah,
so then there's
makes
more
sense.
kind of clarity on the financial assets and liability side.
Yes.
Anyway, so yeah, cool. Thank you very much for your time, Rashmi. Super useful and informal session.
Thank
Um,
you.
so obviously, how can anyone get in contact with you if they have any questions or if they want to reach out to
Uh,
you?
both, as I said, this barcode has my contact details with my WhatsApp mobile number and email ID.
Yeah.
And I'm also available on LinkedIn with Rashmi Rajkumar as my name. So either we connect there or here or through you. If anybody is connecting through you, they can also connect me through Rehan, Techstar, Alpha Pro, anyone. And yeah, we can take the discussion forward on any questions.
No,
It's
no.
it's super important. Only just to highlight, we all are thinking that the returns are 30th September, but then trust me, there is so much that needs to be done, so many decisions that need to be taken, the valuation reports to be adjusted. You need to see what you have kept. So there's so much to do for each provision. We are only talking transition. When you will take every corporate tax assessment impact together, there is a lot to be done. So no, we do not have enough time. So don't look at 30th September, please.
And just to be clear, you not only help businesses, you can also help accounting firms with tax advice and tax, general tax consulting as well.
Yes. So for accounting firms, it sometimes becomes super important, because one, they can take issue-based consulting, and that can apply to multiple of their clients. If they need an understanding on a concept, we also work on that basis. We also do trainings if they want for their clients or their staff or anything
Yeah.
for the firms for any level of support on corporate tax. Yes. Accounting firms are very relevant right now for their different types of clients that they have. They have the most weird mix and instances, right? So
Yeah.
yeah.
Cool. No, thank you very much. My name is Rayhan. I'm the co-founder of Taxstar. So we've built a tax calculation engine. So as Rashmi mentioned, you're gonna have to maintain two books: one IFRS, which is your accounting system, and one is your tax books, which is in Taxstar. So we're more than happy to give you a demo, show you how it looks. We've got some good early offers available. So yeah, feel free to reach out to myself. We will have another session this month. If you guys have any other topics you want us to discuss, feel free to reach out to myself or to Rashmi, and we can consider it as part of our pipeline of webinars that we're looking to do over the next, few months, and give you guys value. So thank you very much, and enjoy the rest of your day. Thank you, Rashmi.
Thank you, Rehan. Masala.